Netflix just reported a strong quarter, by most metrics. This was a beat, but the stock is down after hours, which suggests the real story is somewhere beneath the surface. So let's go through the report and see what actually matters here. Netflix crushed expectations this quarter. Diluted EPS came in at $1.23, roughly 62% above estimates. Revenue reached $12.25 billion, up 16% year-over-year and ahead of guidance. Operating margin expanded to 32.3%, up from 31.7% a year ago, with operating income growing 18%. But one key driver here was a one-off, a $2.8 billion termination fee from Warner Bros., which provided a significant boost to earnings. So why is the stock down anyway? This looks like a classic sell the news reaction, but more importantly, guidance came in a bit weak. For Q2, Netflix guided revenue to around $12.57 billion, slightly below expectations, and EPS also came in light. At the same time, operating margins are expected to compress due to higher content costs in the first half of the year. And despite strong tailwinds like pricing and ads, the company didn't raise its full-year outlook. On top of that, co-founder Reed Hastings stepping away from the board adds a bit of uncertainty around leadership. So the market is basically saying the quarter was good, but most of the upside was already priced in. So the real question is this a buying opportunity, or is the market seeing something the numbers don't show? Because a strong quarter alone doesn't make a stock attractive. To figure that out, we need to go deeper into the fundamentals and the underlying business. Right now, Netflix is a roughly $455 billion company, trading at around 35 times earnings and about 38 times free cash flow. On the growth side, revenue is expected to grow around 12.7% over the next 2 years, while EPS is projected to grow 23.6% over the same period. Long-term growth expectations are around 20.8%. So overall, this is still a business with strong double-digit revenue growth and solid earnings expansion, despite the premium valuation. Margins also tell a very strong story here. Gross margin is around 49%, operating margin about 30%, net margin roughly 28%, and free cash flow margin close to 25%. And importantly, all of these have been trending upward over time. So this is still a very high-quality, highly profitable business with improving efficiency across the board. Return on invested capital also tells a strong story here. ROIC is around 27.6% in 2025, an extremely high level. And more importantly, the trend has been clearly up and to the right, from about 12.5% in 2022 to 22.7% in 2024, and now close to 28%. So this further confirms that this is a high-quality business with strong capital efficiency, which typically justifies a premium valuation. So for the DCF, all the assumptions are laid out on the screen, including revenue growth, margin trajectory, and reinvestment rates. For the discount rate, I used a 9% base case, an 8% bull case, and a 10% bear case. That gives a valuation range of roughly $60 in the bear case, $88 in the base case, and about $146 in the bull case. On a weighted basis, the implied fair value comes out to around $97, which is very close to the current share price of roughly $98. So based on this DCF, Netflix looks fairly valued at current levels. If we also look at an EBITDA exit multiple approach, I assume a 25x multiple in the base case, 28x in the bull case, and 22x in the bear case. That results in a 5-year price target of about $116 in the base case, implying roughly 3.5% annualized returns. In the bull case, we get around $152, or about 9% CAGR. And in the bear case, roughly $90, which is slightly negative at around minus 1.5% per year. On a weighted basis, the target price comes out to about $120.5, or just over 4% annualized returns. On paper, that doesn't look particularly attractive for a high-quality business like Netflix. However, it's important to note that this result is highly sensitive to the exit multiple assumptions. I've used relatively conservative multiples here, and if you assume a slightly higher re-rating, the implied returns would naturally be higher. So overall, this is not a fixed conclusion. It depends heavily on how you think about long-term multiples for the business. Finally, if we run a sensitivity analysis using current EPS of $3.1 and apply different assumptions across scenarios, a 30x PE in the base case, 33x in the bull case, and 27x in the bear case, with EPS growth of 21% in the base case, 24% in the bull case, and 18% in the bear case, we get implied returns of about 19.7% in the base case, 25.1% in the bull case, and 14.3% in the bear case. Overall, this paints a much more attractive picture compared to the earlier valuation frameworks. So when it comes to the question, is this a buy or not? At today's price, I'm not looking to add here. I was buying this business when it was trading at $85 or below. And based on the updated assumptions, I would probably become much more interested again if the stock moved back toward $90 or lower. At that level, the implied returns start to look much more attractive. For example, assuming around 20% earnings growth and a 30x multiple, you're looking at roughly 21% annualized returns over 5 years. Even in a more conservative scenario with a 24x multiple and lower growth, you're still in the mid-teens annualized, which is still very solid for a business like Netflix. So overall, the business itself looks high quality and even attractive on a long-term basis, but at current levels, I would personally prefer to wait for a better entry point closer to $90 or below. That's it for today's breakdown of Netflix. If you enjoyed this analysis, leave a like and subscribe for more deep dives like this. Thanks for watching. See you next time.